Hello, welcome to our conversation on financial statement analysis. Hope you have seen that in the recent past, people have been talking about two companies. The one is Nykaa, the other one is Paytm. On one hand, the Nykaa share price, the market has been absolutely optimistic, and whereas on the other hand, contrary to the expectation, the Paytm has not been doing well on the market. But in this session, we will focus our attention on one company and understand their financials and check whether the financial statements convey any message about the business of Nykaa, the business model of Nykaa, the performance of Nykaa. For that, I picked up the financial statements as available in the red herring prospectus given by the company just before they went for the public issue. And the balance sheet is in the millions. I have just converted that into a condensed balance sheet and a condensed income statement. We can, in order to make sense of these balance sheet, I would like to convert this balance sheet into a common size balance sheet. So we can see that the non-current assets of the company accounts for 26% of the total assets, whereas 38% of the assets are in the form of stock of goods. No wonder, because the business of Nykaa itself is an inventory-based business model. There are other small assets in the form of cash, debtors, and other current assets. Similarly, if you see the non-current liabilities, Nykaa is not a debt-driven company. Less than 10% of the total sources are in the form of the non-current liabilities. The current liabilities account for 53% of the total sources, and a significant part of these current liabilities are the trade payables, and that is also because of its business model, that is inventory-based model, which we will discuss and examine more. Similarly, we can see that the sales of Nykaa has been increasing from 11,000 million to 24,000 million, and 61% of the sales is in the form of cost of goods sold. This is a feature of any inventory-based business model. The profit after tax in 2021, they made a 3% profit after tax, which is which the market says it is definitely a good sign, because this is the first startup IPO company in the recent times which has already having a positive profit just before going to the market. So, but the focus of this session is actually to understand the cash flows, and to check why and how the cash changed during the period. Okay, the cash of the company, we can see, has increased from 113 million to 834 million. So what we would like to examine in this particular session is how and why did the cash change. Did the cash change because they raised money from financing decision? Did the cash change because of operations, or did the cash change because of investment decision? Let us derive the cash from operations, cash from financing, and cash from investment activities to understand the cash flows of Nykaa. We know that profit is not equal to cash, because of non-cash items, because of non-operating items, and because of the changes in the operating current assets and current liabilities. So the objective of this video is not only to understand Nykaa, but also to derive cash flows when the balance sheet and income statement are given. So the profit of the company is equal to 163. First, we will derive for 2020, and then we will see for 2021. So profit of the company is minus 163 million or 16 crore. And profit is adjusted to the non-cash items, non-operating items, and the changes in operating current assets and current liabilities to derive cash from operation. So the non-operating, non-cash item in this case is depreciation. So therefore, we are going to add back depreciation, and depreciation is a non-cash item from the income statement. And we can see there are no other non-cash items. It is only depreciation, so we just adjust it. The non-operating item is interest. Okay, interest is a non-operating because we follow the Ind AS 7, and interest is normally treated as a cash from financing activity. So the interest is 442 million, and on about 44 crores, and interest is because of their non-current liabilities. Then the changes in the current assets and current liabilities. The current operating current assets and current liability. We can see that the current assets are cash, but it's other than cash, and debtors. And for the time being, we'll treat this other current assets as mostly as a non-operating current assets. Similarly, the current liabilities has increased from 4,600 million to 6,948 million, and the debtors have gone up from 579 to 766 million. So let us check the change in the current assets and current liability. So there is an increase in inventory. So increase in inventory means we purchase goods, and because Nykaa is more an inventory related company, inventory based business model, therefore the major change in their operations happened because of the purchase of inventory, sale of inventory, collection of money from their customers. See, the next item is the debtors. It's interesting to observe that the debtors during this period has been changing, so from increase in the debtors from 579 to 984. Increase in the debtors means we can say it is a credit sales, so we have adjusted that. And any other current assets or a current liability? The current liability is increase in current liability from 4,600 million to 6,600 million. So that means the company is using the trade payables quite efficiently. Okay, so the summation of all these should give us the cash from operating activity. It's interesting to observe that though the profit in that year is negative, the company has generated cash from operations positive. But we can also see that from the year 2021. So we can see that the cash from operation has actually increased by 3 times. And this is the year of their IPO. So the company has not only made a profit of 600 million, which was 163 million negative, has become positive 600 million, and continue to have a positive CFO. And we often say that consistent positive CFO is a sign of a strong, financially strong company. So therefore, Nykaa profits are improving, the negative profits are reduced and has become positive profit, 619 crore, 19 million. Along with the positive profit, they have a positive CFO, which sends a positive signal about the company. Now let us see the cash from financing activity. The cash from financing activity can be seen by examining the changes in the non-current liabilities and changes in equity, changes in other equity, interest payment, and the dividend payment. Let us see what happened to the capital. During this period, there is a change in capital to the extent of 3, and a small increase in the capital. Okay, and what about 2021? There is an increase in capital. The other equity, which consists of a significant part of other equity, is a preference shares, share premium, or as in the security premium, and of course the retained profit. And let us see what happened to the other equity. Other equity has gone up from 2,168 million to 3,000 million to 4,757 million. So it is increase in other equity, means issue of preference shares, and that too at a premium. And interestingly, during this period, the company has been repaying the loans. We can see that what happened to the loan in 20, the loans have non-current liabilities increased, whereas in 21, the non-current liabilities have decreased. Okay, so there is a repayment of, and which the company is planning to further reduce the non-current liabilities after this particular IPO. But this data is pre-IPO data based on the prospectus. And similarly, they paid interest, and in both the years, 400 million and 300 million. The summation of this should give us the cash from financing activity. So cash from financing activity has been positive during the year. That means the company is raising money through their financing activity. 1,200 million in 20 and 559 million in 21. Now let us examine the cash from investment activity. The cash from investment activity can be examined or derived by observing the non-current assets and these other current assets, which we have treated them more as investment activities. So let us see what is the investment. So the property, plant, and equipment have been purchased in, so which is a sign of a growing company. A company on the growth trajectory often keep on purchasing the property, plant, and equipment. And similarly, the other assets also, we can see in 2021 there is a significant purchase of increase in the purchase of the other assets. So the cash from investment activities is negative 772 million in 20 and negative 2,300 million. Now let us observe all of them together. So that means the company is making a positive CFO both the years and negative CFI both the years. That means the company is generating cash from operations and using the money to purchase assets, and have also made a small increase in the issue of the preference shares. Obviously, in the current year, when they go for the IPO, there'll be a significant amount of CFF happening. Let me summarize this by showing the cash flow statement together yes. So we had an opening cash in hand 113 million, and we had the CFO positive in both the years. The CFO has been positive, and CFR in both the years is negative. So increase in the acquisition of assets is actually a sign of a growth company, as I mentioned, and the company is able to generate cash flow from its operation. So therefore, from the cash point of view, the business model shows that the Nykaa, even if it is a startup, it is able to make profit. And it is not only able to make profit, but is also able to convert the profit into cash from operation. So let us spend some more time to understand the cash from operation. And understanding cash from operation is understanding the income statement. And in that understanding, the sales, the income from operation. Two important items which will throw some light, more light on CFO is sales and the relevant expenses. Let us see the Nykaa's sale, whatever they have mentioned in the prospectus. So there are three big three broad verticals of revenue of Nykaa. One is the sale of product, other is the sale of services, and other operating revenues. And we can see that a big chunk of the total revenue, is the sale of the products. What is the sale of product? The sale of product is, as they mentioned, relates to the transaction where they act directly as the seller of goods. They purchase from the suppliers and their own brands, which they manufacture and sell them. The revenue from this operation, from the sale, is measured on the basis of the transaction price, which is the selling price, adjusted for some discounts, schemes, concessions, incentives, lots of incentives they give for their repeat consumers. That is the sale of product. So a significant part of the total revenue is the sale of product. And the sale of product is also can be said as a B2C, business direct to the consumers. Whereas sale of services and other operating incomes are actually B2B. But we can see that the sale of product, which is B2C, has increased from 9,000 million in 19 to 21,809 million. Okay, approximately 2.5 times during this period, within a period of 2.5, 3 years. And what is the sale of services? The sale of services relates to the transaction where they actually purchase from suppliers' own brand. That includes two important components. That is the marketing support revenue. They provide a platform to other companies to market their products. So therefore, this is more like a commission. And also put the advertisement of other companies. So they earn income as a commission or charges for using the platform for advertisement. Whereas the other incomes, other income from, they represent some amount of commissions and the logistics services. If you want to get the product faster, then maybe you have to pay some shipping and delivery charges. And besides that, they sell discount cards, and there is a big amount of discount cards being expiration happening. So therefore, we can see that the revenue of Nykaa, a significant part is their B2C. And this is what they want to increase also, improve also. At present, they have presence about less than 100 cities in the country, and post-IPO, they want to increase. And the best part of the sale of product B2C may be that the margins may be high, maybe there will be cash sales. That may be the reason why their CFOs are positive. So therefore, understanding Nykaa is understanding this particular vertical of Nykaa. And let us try to spend some more time in understanding their sales. And interestingly, the Nykaa has compounded its annual sales at a CAGR of 84% per year since 2000. And this is the single most reason why the company is growing fast. This is the single most reason for their profits, their losses getting converted to profit. And this is the single most reason why they are also able to generate a positive CFO. And as already the balance sheet has demonstrated, Nykaa works on inventory-led model. It buys products from various suppliers, brands globally based on demand, and then they sell the product to customers via its platform. In each transaction, okay, Nykaa acts as a direct seller. It's a direct seller, unlike Amazon, where the customer is purchasing an item from the third-party seller. This is the difference between the Nykaa's business model and the Amazon's business model. And as we have already seen the income statement, a bulk of its sales, 90% of the sales revenue come from this particular channel. And so post-IPO, it is possible that this particular part of the business is going to further improve because they're going to expand the business in other cities too. So to come back to our main observation, that we wanted to understand the cash. And to understand the cash, first we derived the cash flows, because here we did not bring the cash directly from the annual report or from the prospectus. Only we got the balance sheet and income statement and derived the cash flows, and we saw an interesting thing happening in Nykaa, that their profit in the latest year is positive, and CFO has been positive all through these 4 years. So the question remains for us to keep a watch on Nykaa, while keeping a watch on Nykaa, whether this trend will continue. Will the price of Nykaa, share price, will keep on rising? What is that in Nykaa which is not there in Paytm? What is the difference in the business model of Paytm and the business model of Nykaa? In this session, we just try to get a grip on the cash flows of Nykaa. Later on, we will try to compare Nykaa with Paytm, maybe Zomato, and understand the financials of these businesses. In the process, understand the relevance of the financial statement. Can the financial statement explain the price? Is a very, very important question. Thank you very much.